we are going to talk about chapter number 5. I have selected this questions from chapter number 5, and let's see what this question is about. So it says, for all problem, assume perpetual inventory system is used unless stated otherwise. And so what is a perpetual inventory system? I'm sure you have read it. There are two kinds of systems in inventory. We use a periodic and perpetual. Periodic, the word came with the word period, which means that an inventory is going to get updated every period. It could be every month, it could be every quarter, every 3 months, every 6 months, or every year. Perpetual inventory system is the system of inventory in which we update our inventory after every transaction, whether we are purchasing or we are selling. So that's the perpetual inventory system. So this question, which is problem PF3 536A, it's asking you to generalizing purchase and sales transaction. So purchase means you are buying it. Sale, you're selling it. Buying and selling. So we have two kinds of transaction, buying and selling, and we're going to generalize these transactions. Generalize means we make a journal entry using debits and credits. So generalize the following transactions that occurred in September for Waterworks. No explanation are needed. Identify each account as accounts payable and account receivable. Accounts payable, when you owe and the business owe an amount to some vendor, and account receivable is a claim that business has on their customers. In accounts payable, it's a liability to have to pay off in near future, and account receivable is an asset that you're going to get cash for it with vendor or customers. So the vendor is associated with accounts payable and customers are associated with accounts receivable. All right. So, and the Waterworks estimates sales returns. Sales return is whatever they are selling if they have sales, if the customer is returning their product, just like you buy sometimes a thing, say from you go to JCPenney and you buy a t-shirt and 2 days later you want to return it because you're not sure it's that good. All right. So in the first transaction that happened on September 3, they purchased, the Waterworks is purchased merchandise inventory on account, means they are not paying cash, from this wholesaler, Shellen wholesaler, for $5,000. And the terms of this, if Waterworks pays within 15 days, they will get a 3% discount on this $5,000. Otherwise, the N means the whole amount is due EOM end of the month, FOB shipping point. FOB shipping point and FOB destination, I'm sure you have read it. FOB shipping point is when the seller product leaves the seller's place. It's called FOB shipping point. FOB destination simply means when the product reaches at the destination of the buyer. So FOB shipping point and FOB destination is very important to figure out when one should recognize the revenue, or when should recognize a sale, or when one recognize, so these two, FOB shipping point and FOB destination, basically decide when the power of ownership is transferred to the other party. So when you go and buy a t-shirt from JCPenney, before you purchase it, JCPenney owns it or controls the t-shirt. But once you purchase it, it becomes yours and you have a control over it. If you return it, you're basically returning the control of the t-shirt back to JCPenney. And what we're going to do, we're going to make these the journal entry for these transactions. So in this case, for this September 3rd, so we're going to date this September 3rd. say it is 2023, and what we are doing, we are purchasing merchandise. So the merchandise or the inventory is coming to Waterworks. So we're going to say debit inventory, and then we're going to say it's for $5,000, and we're going to credit accounts payable for $5,000. So in this accounts payable, who is accounts payable, who you owe this money, or who this Waterworks owe? So you can put a name here in the note, or right over here as a note, vendor is, and we have SHALLIN, Shellin Wholesalers. Okay. In the next transaction, paid freight bill of $70 on September 3rd purchase. So the Waterworks purchased this transaction on September 3rd. They paid $70 for the freight bill. So what is a freight bill? A freight bill is the same thing that an individual may have to pay to Amazon, for example. So shipping and handling, for example. So shipping and handling is the same thing as the freight bill. So who paid the freight bill? So the freight bill is part of the cost of the inventory. So you can say debit inventory, and either you can put a freight bill over here, or either you can say freight over here for $70, or when you credit and you pay cash for $70 and you pay a note over here, freight bill for September 3rd merchandise order. Okay. So the readers know that this $70 belong to this inventory, because when you calculate the total cost of the inventory, you have to include in it. But we will talk about in next chapter about this. And on September 4, again, you have one more transaction in which you purchase merchandise inventory for cash for $2,400. So here they are not saying who the seller is, but the buyer, which is Waterworks, is purchasing merchandise. So we're going to say debit inventory for $2,400, and we're going to credit cash for $2,400. That's all you have to say here, because we are done. There will be no future impact of this transaction until we return it. All right, now we are on September 6, and on September 6 we have another transaction. It says return $1,200 inventory from September 3rd purchase. So we have returned $1,200 of the inventory that we have purchased here on September 3rd. So what we're going to do, we're going to say debit accounts payable for whatever the name of the company was, Shellin Wholesalers, if you want to write this way, wholesalers, and we are returning them for $1,200, and we are crediting our inventory for $1,200. So what we are saying, because we are returning their $1,200 inventory, therefore I am reducing the accounts payable by $1,200. So for example, if I have put a small accounts payable, just for your explanation, that we owe this company $5,000. since we have returned $1,200 of their merchandise, so now we owe them only $3,800. This is just for your explanation, and if you want to make T charts while you are working on your transaction, that will actually give you a very good visual and would help you understand the material. All right, so let's move to the next transaction. Now we are on September 8. It says sold merchandise inventory to Hilton Company for $6,200 on account, means we're not selling it cash. It's going to be an account receivable. They will pay us later. And the term that we are offering them is that if Hilton Company pays us back for this merchandise, we will give them 3% discount if they pay within 15 days. Otherwise, the whole amount is due in 35 days. So the N stands for the whole amount, which is in this case $6,200, and the Hilton Company is obligated to pay within 35 days. However, if they pay within 15 days, we will give them 3% discount. We means here Waterworks. And the cost of goods sold is $2,852, and we will show you how to do this. So we selling the merchandise on September 8. And so what we're going to say, we're going to debit account receivable, because we are selling on account, for $6,200, and we're going to credit sales revenue for $6,200. All right, because we are not talking about discount, because we do not know whether they're going to take the discount or not. And the second transaction, a second journal entry, we're going to make for debit cost of goods sold for $2,852, and we're going to credit inventory for $2,852. So what does it mean here? When we sell something, whether we sell on account or cash, so if we have sold it on cash instead of account receivable, I will put cash here, that we receive the cash. But account receivables indicates that we are selling out on account and the customer will pay us in the near future. So once we make a sale, that we send this in merchandise to them, we can record a sale that our sales revenue because of this sale is $6,200. So what this cost of goods sold, COGS, is equal to cost of goods sold is $2,852. What it means here, that we have sold the inventory that we have purchased, or the inventory that cost us $2,852 for $6,200. So once the inventory is sold, it becomes cost of goods sold. So I will write down this thing for you. Once the inventory is sold, it becomes cost of goods sold. This is an important important point to be remembered, because this is going to be appear many times in this course and in future courses and in your real life. So once the inventory is sold, it becomes cost of goods sold. So that's why we are basically saying the inventory, once it's sold, it becomes cost of goods sold. And there is one more thing. When we make income statement, we use sales revenue, that the second line is cost of goods sold, and when we subtract cost of goods sold from sales revenue, it gives us gross profit, and then we'll talk about later on that. All right, so let's move to the next transaction. We have now September 9. On September 9, we are purchasing merchandise on account from Taylor Wholesalers for $7,000. And the Taylor is telling us that if you pay the $7,000 within 10 days, the Taylor Company, Taylor Wholesaler, will give you 2% discount. And if they did not pay them within 10 days, if they pay beyond 10 days, but they have to pay within 30 days, the whole amount. FOB destination means once we receive this, once we receive this merchandise, then Taylor Wholesaler would recognize that is there a sale, and we recognize the purchase. So FOB destination is just the opposite of FOB shipping point. Okay, so how are we going to say when we are purchasing? We're going to say debit inventory for $7,000, and we're going to credit because we're purchasing on accounts payable for $7,000, and we can note here that the vendor is Taylor Wholesale or wholesalers. That's all we have to note here, because we do not know when we are going to make this payment, so we cannot take the discount as of yet. Now we move to September 10, and it says made payment to Shellen wholesalers for goods purchased on September 3, less return and then discount. So you notice we purchased this on September 3rd, and they gave us 15 days to pay in order to earn a 3% discount, and we are paying them on September 10th, so that means it's only 7 days has passed, and now we are making the so we purchased, total purchase was $5,000, and then we return on September 6th $1,200. So we returned $1,200, so we subtract, so we left with $3,800. Now on this $3,800, we're gonna get 3% discount. So how much that discount would be? So here is our calculator. $3,800 multiplied by 0.03 equals to $114. So our discount that we can claim is $114. It is called a sales discount. All right. So our bill was $3,800, and we subtract 114. So 114, so 3,800 minus 114, it gives us 3,686. So that is the amount of money that we are going to pay to Shellen wholesalers. So in this case, what we're going to show, we're going to say debit accounts payable for, and we put a name SHALLIN wholesalers. And how much was it? It was $3,800 that we have show you the last time over here. So it's $3,800. And then we're going to credit cash for $3,686. Now you must be thinking what we are going to do if we are making the payment for $3,686, and then we're going to credit sales discount for $114. So that will take care of our $3,800 worth of sales discount. Okay. Now we're going to make on September 11, sorry, September 12, 2023. And what we're doing here, we have received payment from Hilton Company less discount. Now you notice that we have sold merchandise to Hilton Company for $6,200 on account terms 3 15, which means if they pay us within 15 days, we will give them a 3% discount. So in this case, we have to calculate the 3% discount on $7,000. So 3% of $7,000, it should be equal to 210, but let's just calculate. So 7,000 multiply 0.03, $210. So they, instead of paying us $7,000, they subtract $210, and how much we're going to receive? 7,000 minus 210, we will receive $6,790 dollars. I am sorry, I have to go back on this one. This one was a purchase discount, not the sales discount. My apologies. I just realized a purchase discount, not the $114 you are paying less because they gave you a purchase discount. Sales discount will be provided to customers, and purchase discounts received from, so I'm just putting it, you don't have to put it here, received. Sale purchase discounts are received, sales discounts are given. All right, so my apologies for that mistake. All right, so we are making receive payment from Hilton Company less discount. So how much cash? So we are receiving debit cash for $6,790, and we are crediting account receivable for $7,000. So we're going to debit another one, is called sales discount that has been given for $210. Okay. So they purchased from us $7,000 worth of merchandise, and they are paying back within a week. They have 15 days to pay. So they earned 3% of discount on $7,000, which is $210. So we subtract $210 from 7,000 is 6,719. Their our claim on them was $7,000. So account receivable is like a claim. So they earned the discount for $210, so they don't have to pay $7,000 the total. They subtract the $210 and they send us a check or cash for $6,790. Okay, let's move to September 13. After negotiation, receive a $250 allowance from Taylor Wholesalers. All right. So after negotiations, received a $250 allowance from Taylor Wholesale. So who are Taylor Wholesaler in this case? If you look at the Taylor Wholesale name appear on September 9 when we purchased merchandise inventory on account from Taylor Wholesalers for $7,000, and that was the term transaction. So we receive an allowance. So when we receive an allowance, so what kind of information we have to give them here? So let's go back on September 9. What happened on September 9? So here is September 9. September 9, we purchased inventory for $7,000, and we have an accounts payable that we owe them to Taylor Wholesaler. They have given us a $250 allowance. So what do we call this allowance? It's called purchase allowance. So we're going to say debit accounts payable for $250, and we're going to credit purchase allowance for $250. That's all we have to do. Accounts payable $250, and we're going to purchase allowance for $250. That we will be doing for this September 13 date. Okay, let's move to September 15. On September 15, we sold merchandise inventory to Julian Company for 3,300 on account. Again, we are not receiving cash. We have an account receivable for $3,300. And then we credit sales revenue for $3,300. And the terms are the whole amount is due by the end of the month, and there are no discounts are offered to Julian Company. And the cost of goods sold is $1,485. So we're going to get cost of goods sold $1,485, and we're going to credit inventory for $1,485. Now again, when an inventory is sold, it becomes cost of goods sold. So crediting inventory is going down or going outside the business, and hence we have $1,485 of cost of goods sold. And this $3,300 is our sales revenue, because for $1,485 inventory, we charging $3,300 in revenue. Okay. Now let's go to September 22nd, and here we are made payment less allowance to Taylor Wholesaler for goods purchased on September 9. So September 9 we purchased $7,000, and on September 13 we earned a $250 allowance. So what we're going to do, we're going to make a payment. So we make a payment 7,000 minus 250 is equal to 6,750. So we're going to credit cash of 6,750. We're going to debit accounts payable for $7,000, and we have a credit purchase allowance. So I believe we have already done that here. Oh, we have already in this case we have already reduced our accounts payable for $250. So for example, your accounts payable was $7,000. We have reduced by 250, so it's 6,750. So we just put 6,750 over here, and we put the cash because we have already taken purchase allowance. If I do it again, it will be double dipping. So once you do that, you reduces the accounts payable. So once you do this, both are recorded. So all you have to do is to debit accounts payable for 6,750 and credit cash for 6,750. You don't have to do twice. Otherwise, your purchase allowance would be $500. Okay. Now we move to September 25th, 2023. On September 25th, we have sold merchandise inventory to Shelton for $1,500 on account that cost $660. All right, so let's make the journal entry for this one first. So debit accounts receivable for $1,500, and we credit sales revenue for $1,500, and then we're going to debit again cost of goods sold is $660, and we credit inventory for $660. That's happens in these first two lines. Now we're going to read terms is 310, means the merchandise we are selling to Shelton has 10 days to pay if they want to earn 3% off discount. Otherwise, they will pay the whole amount in 30 days. FOB shipping point means as soon as the merchandise leaves our dock, they are responsible for that. As a courtesy to Shelton, $75 of freight was added to the invoice, for which cash was paid by Waterworks. Because we have already paid cash for $75, so what we're going to do is we will add $75 to it. So instead of $1,500, it will be $75 here. So I am going to rewriting the same thing over there. So it's a debit account receivable for $15.75, and then we're going to credit sales revenue for $1,500, and then we're going to credit cash for $75 because we have already paid cash. Or you can put debit freight for $75 and leave this as $1,500. We can do it both ways, and we can give them this information about it. We can add this freight there in the bill, both pieces of information. This is for inventory and this is for freight. And then we have paid $75 for cash. Okay. Let's move to 29. In 29, received payment from Shelton less discount. So let's see where we made a sale to Shelton. Here on 25 made a Shelton, so we left less discount. So Shelton purchased $1,500. He's making a payment in 4 days, and there was a 3% discount on it if they pay within 10 days. So $1,500 multiplied by 0.03 gives you $45 discount. So that means they are going to pay you $1,455. So we're going to receive cash, debit cash of $1,455. We're going to credit account receivable for $1,500, and then we're going to debit sales discount for $45. This is what we have to do. Then on September 30th, we received payment from Julian Company. Let's see. So we receive Julian Company when we made a sold to Julian Company. So on the 15th, we sold inventory Julian for $3,300. And as you see, their term of condition is whole amount is due by end of the month. So that means we're going to receive debit cash $3,300, and we're going to credit account receivable for $3,300. Okay. We don't have any more transaction. So this is a very significant question, because you will be seeing the similar item with some more details in the next couple of chapters. So I hope this video will help you improve or solidify your understanding of chapter 5. If you have any question, please feel free to contact me via email or come during my office hours. I have office hours. You can find the information in your syllabus. Again, thank you very much for watching this video.